Hi, I am Anna. I come from www.ntvforex.com. Symptomatic of confusion over the state of the U.S. economy analysis. http ntvforex.com news ID to 9F3A818-2021 03:59 p.m. Outlook. To the degree that congressional gridlock on the next recovery bill has brought some measure of risk on $N support, that could be ending. Bloomberg reports Senate Republicans have an alternative to the Dems House bill that includes $300 week enhanced unemployment benefits, money for small business aid, additional U.S. Postal Service funding and protection for employers against lawsuits stemming from COVID-19 infections. This comes from an aide and has not been picked up by the rest of the press. Meanwhile, the House will vote Saturday on a bill that beefs up funding for the Postal Service and prohibits cutbacks in service before the election. Symptomatic of confusion over the state of the U.S. economy is the weird combination of sky-high demand for new housing and the rising trajectory of mortgage delinquencies. These two things should be inversely correlated. Bloomberg offers a chart. It seems obvious that the new house demanders belong to one population cohort, middle class, while the defaulters belong to another, working class and non-savers. The FT has a story on the falling dollar and another one on the rising euro, reprising the sharp reversal last week, with some saying it's only just begun but others warning it's a flash in the pan and already overdone. The dollar is down because it was previously overinflated. We want to get picky about the assertion the euro is at a 2-year high and the dollar at the lowest since before the pandemic hit hard in March. To say the euro is at a 2-year high may be true, but it's not useful. Thank you, Mrs. Saunders. See the monthly basis chart. The euro has been downtrending since July 2008, which is 12+ years. No one can say whether the euro will be a continuation trade to challenge the last high, 1.2583 from January 2018. As for the dollar, failing euro rallying to the extent of a return to the starting point, 1.6038 from July 2008, it would take quite massive change in conditions to imagine that. We see two things here, facts and sentiment. On the facts side, we do indeed already have a drop in foreign governments buying new U.S. debt. That word "new" is important because foreigners still own vast amounts, they just don't want to buy their customary share of the new issuance, which is humongous, $4.26 trillion in the latest year ending in June. According to woflstreet.com, which offers a decent reading of yesterday's capital flow ticks report, foreign entities now hold a total of $7.04 trillion, a huge record pile, but their share of total debt, $26.45 trillion on June 30, crashed to 26.6%, the lowest since 2008. Who picked up the slack? We did, we meaning American entities. It's dead wrong to say which we expect to see any minute that foreign governments are walking away from US paper or the dollar. They are not. They just have a firm idea about how much they want or can afford to buy. And let us not forget they have their own internal constraints, too. That brings us to musing about sentiment. We use sentiment and or instinct as much or more than reasoning to evaluate risk. A point we are all missing, perhaps the equity boys most of all, just because money is cheap doesn't mean risk is lower. Risk has a life of its own, and when equities are bubbling, all the talk about earnings ratios and other basics means quota bubbles burst because of a surplus of fear. Another definition of surplus of fear is sudden recognition of risks previously neglected or ignored. We should apply this same little gem to the dollar. Apart from lacking any agreed upon definition of true value except perhaps the economist's Big Mac semi-jape, the dollar does suffer from extraordinary privilege, meaning its reserve currency status allows it to borrow more cheaply than anyone else. So let us say the US borrows and borrows some more, whether for Republican things, defense, tax cuts for the rich, or Democratic things, universal health care, green energy, and confidence in the ability to repay troops. The currency will fall in value vis-a-vis other currencies where the risk seems less. We are inclined to think this outcome is inevitable no matter who wins politically. Fiscal conservatism flew out the window when Trump came in the door, and overspending has now become a chronic condition. While we hear a plaintive wail about debt control from time to time, it's mostly from people who are otherwise fairly crackpot and thus not heated. The dollar has other advantages, like a really big country with some really smart and inventive people, not to mention an infinite supply of varied financial instruments and a quite good financial system, Fed independence, clearinghouse excellence, so sovereign indebtedness is not the only issue, just the biggest visible risk to the relative level of the dollar. The debt ratio didn't help the dollar when Clinton improved it or harm the dollar when Trump smashed it, but for the sake of argument, let us say that sentiment has indeed turned against the dollar and will turn against it even more on the new indebtedness that is sure to come. This would be a perfectly reasonable acknowledgement of a hitherto neglected risk, but in the absence of viable alternative currencies that are safe and liquid, a creeping crisis, not a fast shock. Here's the problem: it can go on for a very long time, scare the Fed at least a little, and result in higher yields needed to peddle the new debt. This is, in fact, our current forecast. Some kind of cycle has begun of mistrust-distrust in the US, and it's visible in the capital flows and dollar prices. Bottom line: Trump might have gotten away with the addition to the national debt, but the pandemic spending already in place and yet to come worsened the perception of US sovereign risk to the point where foreign demand for US debt is not falling, but not increasing at the same pace as issuance. We do not like talk of cycles. Sure, cycles do exist, but there are too many of them and they contradict one another. We sure can't measure this anti-US, anti-dollar sentiment in terms of how many months it will last. We went through 2 decades of anti-US, anti-dollar sentiment, and for all we know, this time will last that long, too. But that assumes all other factors remain the same, the sometimes fatal ceteris paribus condition of all economic forecasting. If we want to build a doomed dollar scenario, we must assume that the other countries do well, or at least do not suffer a countervailing shock. What could that be? Candidates range from hard Brexit to some kind of military confrontation in Belarus or elsewhere. There's Iran. There's Turkey. There's the South China Sea and batshit crazy and Korea. There's a natural disaster in combination with the pandemic. There's even central banks scurrying to invent cryptocurrencies. We don't exactly have a run on the banks, but we do have a run toward both gold and crypto. A sufficiently big enough crisis or shock can easily turn sentiment back to the key safe haven. So don't bet the ranch. Tidbits: in addition to slashing emissions rules, now the Trump administration will open up 1.5 million acres of the Arctic National Wildlife Refuge to oil and gas drilling. There's something about that word refuge Trump fails to grasp, probably ears closed to listen instead to the cash register. Sales of leases can begin almost immediately. The NYT reports environmentalists and Alaska Native groups are expected to file lawsuits to try to block the sales. NBSP. This is an excerpt from the Rockefeller Morning Briefing, which is far larger, about 10 pages. The briefing has been published every day for over 25 years and represents experienced analysis and insight. The report offers deep background and is not intended to guide FX trading. Rockefeller produces other reports in spot and futures for trading purposes. To get a 2-week trial of the full reports plus trader's advice for only $3.95. Click here. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://m.me/mt5.expert.advisors.